Good morning. Are you self-employed and wondering how to handle your solo 401k at tax time? Well, you're not alone. Many business owners make mistakes that can lead to penalties, missed deductions, or even taxation. In this webinar, we are going to break it down step by step so you know exactly what forms you need, what deadlines to watch for, and how to avoid costly IRS errors. Today's topic is, how do I report a solo 401k on my taxes? Go ahead and type over your questions during the live webinar, and we'll pause and answer those questions as they come in. Please also like today's video as it helps us get the word out to other solopreneurs like yourself. Please also subscribe to our channel so you can receive notifications regarding when we go live. We typically go live once a day, oftentimes twice a day. Our video catalog on our YouTube channel is very useful as it covers all aspects of retirement accounts. When you type over your questions today, they don't have to be pertaining to today's topic. They can be regarding any topics surrounding retirement accounts. Please also visit our community where you can post guest blog posts, link it back to your website so that our 30,000 members plus can review your services to determine whether they may be helpful for them. Please also visit our artificial intelligence page, which is www.solo401k.ai. And again, go ahead and type over your questions during the live session here, and we'll go ahead and pause and answer those questions as they come in. Looks like we already have a question here from Barry. Client works at a university hospital but does not participate in retirement plans per W-2. Also has medical business on the side. Could the affiliated service group rules disallow a solo 401k? Good question. So there are the affiliated service group rules, and then there are the control group regulations. And for those who are not familiar with those regulations, they can get pretty complex pretty quickly. In a nutshell, it has to do whether or not you can participate in a solo 401k plan if you own other businesses. So in this case here, it sounds like this individual here only owns one business. So he's not an owner in the hospital. That's number one. So there are no control group regulations. So the control group rules surround whether or not the individual owns multiple businesses. And typically, if he or she owns multiple businesses, that may preclude that individual from opening a solo 401k, even for his other business that only has him as the owner employee or her as the owner employee. And then there are the affiliated service group rules, which I like to look at as a subset of the control group regulations. Those deal more with regards to whether or not you have let's say you have two businesses, and let's further assume that one business is just you, and then you've got a second business where it's actually your spouse's business. It's not your business, but rather your spouse's business. And your spouse employs a full-time W-2 employee who's a non-owner in her business. Well, if her W-2 employee in her business does work for your business, so your separate self-employed business, then that's going to trigger the affiliated service group regulations, because the W-2 employee in her business not only does work in her business, but also does work for your other business. So your business, we're giving an example here of a husband and wife. So in this scenario here, I don't see any affiliated service group issues here unless you've got hospital workers from that daytime employer also working for your self-employed business. But I don't see that happening here, especially if this individual is a contractor and he has his own side business. So I don't see how an affiliated service group would even come into play unless, again, the hospital that he's the W-2 employee of has employees that also work in his side business. So no, I don't see any affiliated service group regulations impacted there. Let me send over a link to the affiliated service groups and control group regulations so you can take a look at it. We'll also provide the IRS link. The rules get so complicated that the IRS has a whole chapter dedicated to those regulations, and it's over 50 pages long. But let me pull it up here. Give me a moment here. So here's the link to the page on our website. And let me send the link to that IRS chapter that covers those control group affiliated service group regulations. Give me a moment here. Okay, there's that link to that publication. There's a specific chapter on that, on those regulations. Okay, thanks for your question. Let's begin here with our presentation here, which is how do I report a solo 401k on my taxes? So solo 401k reporting is not the same as an IRA. That's very important because I get that quite a bit. It's similar, but it's not exactly the same. So you got Roth, pre-tax, and after-tax contributions that differ. So a solo 401k plan allows for Roth contributions, pre-tax contributions, and voluntary after-tax contributions as part of the mega backdoor. Also, if the balance of the solo 401k is over $250,000 in market value as at the end of the plan year, then a Form 5500 Easy is required to be filed. What is more, when you close a solo 401k plan, regardless of market value, you also have to file a final 5500 Easy to formally close the plan with the government. As far as solo 401k reporting not being the same as an IRA, one instance that I can think of is when a client decides to process a conversion where they convert pre-tax solo 401k funds to a Roth solo 401k, for example, or even to a Roth IRA, the codes are different than if you convert a traditional IRA to a Roth IRA. And we'll go more in depth regarding those reporting codes here as we continue with this presentation here. So here's some of the content we're going to talk about. Which IRS forms apply to solo 401k contributions and distributions? When to file a Form 5500 Easy to avoid penalties, how to report rollovers, conversions, and Roth contributions. What you do not report to the IRS. So which IRS forms apply to contributions that are made to a solo 401k plan? Well, number one, we get this question quite a bit regarding how do I report contributions to my solo 401k provider? So for example, if my solo 401k financial is your solo 401k provider, we'll get that question. And the answer is you do not report those contributions to your solo 401k provider. Instead, those are reported on your business and or personal tax return. What is more, the bank accounts and brokerage accounts will actually be used to track those contributions. So contributions are tracked within the bank and or brokerage accounts under the name of the solo 401k plan. So you don't need to complete a contribution form because they are tracked within those bank or brokerage accounts for the solo 401k plan, and they are reported on your business or personal tax return. So keep in mind that when you open a solo 401k plan, if you look at the image on the left, this is an example of a one-person solo 401k plan. So there's only one person who's self-employed. So it's called a one-participant plan. You're going to have separate holding accounts under the solo 401k plan. So one plan, three separate holding accounts, because you need to separately track each solo 401k contribution source. You've got a pre-tax solo 401k bucket, Roth solo 401k bucket, and voluntary after-tax solo 401k bucket, also known as holding accounts and or brokerage accounts or bank accounts. So one plan with separate bank or brokerage accounts to hold each source of funds. So that's how the funds are tracked inside the plan through the actual holding accounts, aka bank or brokerage accounts for the plan. The image on the right is an example of a two-participant plan. Let's say you and your spouse are both self-employed in the same self-employed business. Let's say it's an LLC. Well, the LLC sponsors the solo 401k plan. Solo 401k plan is a defined contribution plan. So you each would have separate bank or brokerage accounts, aka holding accounts under that solo 401k plan to hold your respective funds and fund sources. So this is an example of 6 bank or brokerage accounts under your solo 401k plan to hold your respective fund sources. So it's not 6 separate solo 401k plans, it's one plan with 6 separate holding accounts. So again, that's how the funds are accounted for, is by making the contributions into those respective accounts. As far as reporting those contributions, those will be reported on your personal and or business tax return, depending on the type of contribution. So, and also how your self-employed business is taxed. So for example, we've got slides here. We got an example here of an LLC tax as an S corporation. Here's a second slide of an LLC tax as a sole proprietorship. And here's a final one for an LLC tax as a, actually this one's taxes for an LLC tax as a partnership. The previous one was for an LLC tax as a sole proprietorship. So these are great slides to refer to. We also have a link on our website where we obtain these slides from. Let me share that link so you have it at your fingertips. But again, reporting contributions for the solo 401k plan is going to be based, number one, on how your self-employed business is taxed. And then number two, on whether you make it as an employee contribution, employer contribution, or as a voluntary after-tax contribution. There's that link there where I obtain these cheat sheets for reporting contributions from our website. So we're not going to go over all of them right now, but you can refer to our website for more information. But let's go over one here. Let's look at the one for a S corp or an LLC tax as an S corporation. So if we look at the slide here, hopefully you can see the full image as I'm blowing it up here on the screen. So let's look at this. So reporting contributions for an LLC tax as an S corporation or an S corporation. So the contributions, whether employee, employer, and or voluntary after tax, are going to be based on your W-2 wages from your S corporation. So you're going to need to have enough W-2 wages to support the contributions that you make to your solo 401k plan. So let's say your business is an S corporation. If you make pre-tax or Roth employer contributions, so employer contributions can be made as pre-tax contributions or as Roth contributions, and that's resulting from Secure Act 2.0. So if you make a pre-tax employer contribution or a Roth employer contribution, it's the same reporting. You're going to report those on the employer tax return, which would be Form 1120S for an S corporation. And those will be reported on line 17 of that Form 1120S. Now, if we're talking about employee contributions, and we're talking about employee pre-tax contributions, not employee Roth, but employee pre-tax solo 401k contributions, those are not reported on your Form 1120S for the S Corp. Instead, they are reported on Schedule 1, line 16, which is an attachment to your personal Form 1040 tax return. So that's if it's an employee pre-tax contribution. Now, you also have the option of reporting employee pre-tax contributions on your W-2, box 12 of Form W-2. So you can choose whether to report them on Schedule 1, line 16, which is an attachment to your Form Personal Tax Return Form 1040, or on your W-2. However, don't report it on both, because now you're going to be double dipping. So I typically see a mixture as to whether the individual reports it on their Schedule 1, line 16 versus box 12 of their Form W-2. Oftentimes I see where it's not reported on the W-2 because with the solo 401k, you have until your business tax return due date plus timely filed extension to make both employee and employer contributions. So if the W-2 has already been issued for the year, the individual, instead of having their payroll company reissue that W-2, they'll just go ahead and report that employee pre-tax contribution on Schedule 1, line 16. Now, if you open a solo 401k with the solo 401k provider like my solo 401k Financial, who offers a plan that allows for the mega backdoor Roth, then you can also make voluntary after-tax solo 401k contributions. If it's an LLC, taxes an S corporation, and you make voluntary after-tax contributions, you are not required to report those anywhere, including the W-2, because you don't get a tax deduction when you make those contributions. However, you can choose to report it on your W-2. And if you do, it's going to be reported in box 14 of your Form W-2, but you're not required to report them there. Again, you don't get a tax deduction for making voluntary after-tax solo 401k contributions, which is part of the mega backdoor Roth strategy, because those are made on an after-tax basis, so there's no tax deduction. Now, you can also make employee Roth solo 401k contributions. So with the solo 401k, you can make employee pre-tax contributions as well as employee Roth solo 401k contributions, but you got to make sure you stay within that limit, which is $23,500 for tax year 2025, for example. So if you do make an employee Roth solo 401k contributions, those are reported in box 12A of Form W-2. And you're going to use code AA, and you're going to check off box 13 labeled retirement plans. So that's important to understand that regulation. Now, we just talked about a little bit earlier about how a solo 401k also allows for employer Roth solo 401k contributions. And we already talked about how those are reported just like employer pre-tax solo 401k contributions on your 1120S if you're self-employed business tax with an S corporation. Well, you also have to report, if you do make an employer Roth solo 401k contribution, there's additional reporting as well. That's going to be treated as a taxable end plan conversion on the personal side. So there's a Form 1099-R that's going to have to be issued to report that employer Roth solo 401k contribution that's taxable, and that's going to be reported on a Form 1099-R. And it's also going to be reported on Form 1040, lines 5A and 5B. So again, we have slides here regarding reporting contributions for the various self-employed entity types. So proprietorship, S Corp, and partnership. We just went over the one for an S corp. I'm not going to go over the other two, but we do have these listed on our website. I shared that link as to where you can find that, those cheat sheets, so you can refer to them. Okay, let's keep moving on here. So let's go back here. So we just talked about contributions. Let's talk about reporting solo 401k distributions. So again, today's topic is, how do I report a solo 401k on my taxes? So distributions from a solo 401k plan, as well as conversions, when you convert pre-tax solo 401k funds to the Roth solo 401k, or voluntary after-tax solo 401k funds to the Roth solo 401k, reporting also applies. So distributions and conversions, for that matter, are going to be reported on Form 1099-R. So, for example, let's say you take a distribution from your solo 401k. The distribution amount is going to go in box 1, labeled gross distribution. The taxable amount is going to go in line 2A, which is labeled taxable amount. So let's say you decide to make a distribution from your pre-tax solo 401k. Let's assume that you are age 59 and a half or older, because you have to meet a triggering event in order to distribute funds from the solo 401k. So if you decide to make a distribution of pre-tax solo 401k funds, let's say you're over age 59 and a half, let's say you distribute $100,000. Well, box 1 will list $100,000, the gross distribution amount. Box 2A, the taxable amount, will also list $100,000, because these are pre-tax solo 401k funds. And then in box 7, distribution code, because you're over age 59 and a half, a code 7 is going to be populated there. It's known as a normal distribution. So box 7 lists code 7 as well if you make a distribution from your pre-tax solo 401k and you're over age 59 and a half. Now, let's say you're under age 59 and a half, but you're distributing funds that were previously transferred to the solo 401k from an IRA or a former employer plan, or you've made employer pre-tax contributions and they've been in the plan for at least 5 years. Those can be distributed even though you're under age 59 and a half, but instead of using code 7, it's going to be used at code number 1. Early distribution will be populated in box 7 of that Form 1099-R. The box 1 and box 2 will remain the same, because these are funds you're distributing from the pre-tax solo 401k. So that's how you report distributions. So here are some more codes. There's a code 5 for a prohibited transaction. That's a no-no. Let's say you invested your solo 401k in a rental property and you accidentally use that property for personal use. That's going to be deemed a prohibited transaction. So code 5 would be populated in box 7 of that Form 1099-R instead. Now, let's say you decide that you want to process let's say that you cease self-employment activity, which means you're going to have to close the solo 401k plan down, because you cannot have a solo 401k if you're no longer self-employed. So if you close the solo 401k plan, and let's say you transfer it to an IRA, there's going to be a code G as in George listed in box 7 of that Form 1099-R. Box 1 will list the total amount transferred to that IRA. Box 2A will list 0 as the taxable amount, because when you do a direct rollover from a pre-tax solo 401k to a traditional IRA, SEP IRA, or simple IRA, that's a non-taxable event. And you use code G in box 7 to report that non-taxable direct rollover if we're referring to pre-tax solo 401k funds. Now, if you are, same example, let's say you no longer are self-employed. Let's say you also have Roth solo 401k funds in that plan. Well, the code H will be used in that box 7 if you do a direct rollover of your Roth solo 401k to a Roth IRA. So instead of a code G, it's going to be a code H if you do a direct rollover of the Roth Solo 401k to a Roth IRA. So code H in box 7. Box 1, a gross distribution would list the total amount of Roth Solo 401k transferred out. 2A, the taxable amount would have 0 because it's a non-taxable event. Now, let's say that you want to do an in-plan conversion. Let's say you want to do the mega backdoor Roth conversion and you want to convert pre-tax, excuse me, so you make a voluntary after-tax solo 401k contribution. So the voluntary after-tax contribution would flow into this bucket right here. The voluntary after-tax solo 401k bucket. You then convert it to the Roth solo 401k or even a Roth IRA. That's not going to be a taxable event unless there are some earnings, which that's why you want to convert those voluntary after-tax solo 401k funds immediately as part of the mega backdoor Roth so that there are no earnings. So when you convert those over to the Roth solo 401k or the Roth IRA, and listen carefully here because the code that applies is going to be a code G. That's different than the code that would apply if you were doing a Roth IRA conversion. Roth IRA conversions have a different code. I don't have that code at my fingertips, but I think it's a code 2, but I can't remember. But again, but we're converting here from a voluntary after-tax solo 401k to the Roth solo 401k or the Roth IRA. So it's going to be a code G in both instances. So a code G would be listed in box 7 of that Form 1099-R if you process a conversion of voluntary after-tax solo 401k funds to the Roth IRA or the Roth solo 401k. So you would list code G in box 7. Box 1 will list the gross distribution. Let's say you made a mega backdoor. Let's say you did a voluntary after-tax solo 401k contribution for tax year 2025 and tax year 2025 of $70,000, which is the overall limit for tax year 2025. Let's further assume that there were that $5 accumulated after you made that contribution in that voluntary after-tax bucket. So you convert the entire amount in that voluntary after-tax bucket because you got to convert the entire amount. So box 1 gross distribution is going to list a total of $70,005 as the gross distribution. Box 2A will only list $5 as the taxable amount. Box 5 is going to list 70,000, which is the total voluntary after-tax contribution. And then box 7 is going to list the code G. That's how you report mega backdoor Roth solo 401k conversion, whether it's converted to the Roth solo 401k or the Roth IRA. And the IRS is going to know the taxable amount it's only going to be $5 by referring to box 2A. So let's use an example of converting pre-tax solo 401k funds. So we just did an example of converting voluntary after-tax solo 401k funds as part of the mega backdoor Roth. If you convert pre-tax solo 401k funds, those get converted to the Roth solo 401k plan if you're under age 59 and a half. They cannot be converted to the Roth IRA unless certain triggering events are met, and one of those is age 59 and a half. But let's say you're converting from the pre-tax solo 401k bucket. So let's pull up our different buckets here. So from this bucket right here, the pre-tax solo 401k bucket, you're doing an in-plan conversion from the pre-tax solo 401k bucket to the Roth solo 401k bucket. So that's going to be reported on the Form 1099-R as a taxable conversion. So there's going to be a code G. Again, code G is going to be used in box 7. Don't confuse the Roth IRA conversion rules. We get a lot of CPAs that mix up those rules. Roth IRA conversion reporting is different than pre-tax solo 401k conversions. So if you convert pre-tax solo 401k funds, let's say you convert $50,000. You're going to list 50,000 in box 1, the gross distribution. Box 2A, the taxable amount, you're going to list 50,000 again. Box 7 you're going to put a code G. The IRS is going to know that 50,000 is taxable by looking at box 2A. That's how the Uncle Sam knows that 50,000 it's taxable and that it's a pre-tax conversion, an in-plan conversion of pre-tax solo 401k funds to the Roth solo 401k. So the takeaway is that box 2A is very important. That's how the IRS knows which amount is taxable. Okay. Let's see, we might have some questions here. Go ahead and like today's video to help get the word out to other solopreneurs, please. Got a question here. If I set up a solo 401k before October 15, retroactively for 2014, what kind of contributions can I make? Well, number one, you're only going to be able to open a solo 401k plan here in 2025 so that you can make tax your 2024 contributions if you're a sole proprietor. Because what? Today's September 26th. So the S Corp and the partnership deadline has already passed. But if your business is taxed with a sole proprietorship, then not only do you have to open the solo 401k plan by October 15, 2025, but you're also going to have to make the contribution, and you're only going to be able to make voluntary after-tax solo 401k contributions and or employer profit sharing contributions, but you cannot make employee contributions because the plan had to be open by the end of last year in order to make employee contributions. So you'll be able to make employer contributions and or voluntary after-tax solo 401k contributions, but you're going to have to allow enough time to open up the holding accounts and make those contributions and then open the bank or brokerage accounts. So you need to get started right now to allow for enough time because that clock is ticking. That October 15th clock is ticking. Good question. Okay. So let's continue with our daily webinar for today, which is how do I report a solo 401k on my taxes? We've already discussed how to report contributions, distributions, as well as conversions. Now let's talk about Form 5500 Easy reporting. So Form 5500 Easy applies in two instances. The first instance is if the market value of your solo 401k plan is greater than $250,000 as of the end of the plan year. And you have to take, and when determining the total value of that plan, you have to take into account all of the holding accounts within that solo 401k plan. So let's look at that slide here. So here's an example of a one participant plan. You're going to have to add all of the amounts in the pre-tax, Roth, and the voluntary after-tax bucket to determine if the total value of the plan is over $250,000. So it's not on a per bucket, it's on the entire plan. So if it's a one participant plan, you have to look at it all three buckets. If it's a two participant plan, let's say both spouses are self-employed in the same business, therefore it's one plan, you have to add all the buckets for both spouses under the one plan. So you have to add them all together, and when added together, if the market value is greater than 250,000 in value, then you have to file a Form 5500 Easy for that solo 401k plan. So here's a good slide here on that. So this is assuming that you've got a plan year ending December 31st. If it's less than 250,000 in value, then a Form 5500 Easy is now required. If it's over 250,000, then a Form 5500 Easy is required by July 31st of the following year. So if the balance of your solo 401k plan, let's say the fair market value of your solo 401k plan is greater than 250,000 as of December 31st of tax year 2025. So you look at the total, all the investments, whether it's real estate, equities, all the cash, and your solo 401k plan, all the different holding accounts. If the market value is greater than 250,000 as of the end of the year, so as of December 31st of 2025, you're going to have to file Form 5500 Easy for that solo 401k plan by July 31st of next year, so July 31st of 2026. Also, when looking at the Form 5500 easy threshold, you also have to, again, take into account all your investments. Those have to be added in that market value. Also, your outstanding participant loans. You can borrow from a solo 401k plan where you can borrow 50% of their solo 401k balance, not to exceed $50,000, and you pay it back monthly or quarterly, typically over a 5-year period. That's counted as an asset for Form 5500 easy purposes. So you need to include the value of that outstanding solo 401k participant loan in the total market value at the end of the year. Now, for clients of my solo 401k financial, we'll prepare that Form 5500 easy for you at no additional cost, and we'll even file it electronically for you with the government. Now, we don't have access to your money. That's one of the reasons why we have so many clients, because we let you choose where to hold the money at. And we don't have access to your funds. So the funds can be held at your local bank, whether it's a big bank, regional bank, credit union, or even at a brokerage firm like Fidelity or Schwab. But we don't have access to your funds. So you need to let us know once that market value of your solo 401k plan is greater than 250,000, so that we can assist you in preparing that Form 5500 easy. As long as you timely request that preparation, we will not charge you an annual fee. Excuse me, we will not charge you an additional fee. That'll be covered in our annual fee. So we will not charge an additional fee as long as you timely request it. If you don't follow that timely with the government, then you're going to have to pay a late fee of $250 per day that it's late. So that can add up pretty quickly. Now you can file for relief under the penalty relief program and pay $500 up to $1,500 for 3 consecutive years that you missed out 5500 easy, but that's only available if the IRS doesn't catch it. If the IRS catches it, they're not going to give you that relief. So it's important to understand that Form 5500 easy filing requirement. As I mentioned earlier, there are 2 instances where the Form 5500 easy applies. We talked about if the value of that solo 401k plan is greater than 250,000 as at the end of the plan year. The other instance is when you close a solo 401k plan. When you close a solo 401k plan, you also have to file a Form 5500 easy. It's known as a final Form 5500 easy, regardless of account value. So if your account was only worth 100,000 or only 50,000 or only 2,000, so less than 250,000, you're still going to have to file a final Form 5500 easy to formally close that plan with the government. So that's very important that that 5500 easy also gets filed. Okay, so we went over all these different aspects about how to report solo 401k on your taxes. Looks like here we got a comment from Schuler. I was told that voluntary after-tax contributions are not possible. I'm not sure who told you that. Maybe a different solo 401k provider. Our clients have been making voluntary after-tax solo 401k contributions as part of the mega backdoor Roth strategy since 2014. As a matter of fact, we were the first solo 401k company in the space to offer a solo 401k that allows for voluntary after-tax solo 401k contributions. Not all solo 401k providers like Fidelity or Schwab allow for it, but a company like my solo 401k financial does. Okay, well, thank you for joining today's daily webinar. Until next time, have a great rest of the day.